There are some simple tax strategies that most people completely overlook. And these are things that can reduce your taxes without overcomplicating your life. Now, there are about 14 here that I'm going to go through, and they work for most people. So you should be able to find a vast majority of these will work for you too. The goal here is to lower your taxes without overcomplicating your life. Now, look, my top priority in life is to enjoy my life. Yes, I want to pay the least amount possible in taxes. Yes, I want to continue to look for ways to lower my taxes, but not at the expense of actually enjoying my life. I actually have another video titled Why Smart People Want to Pay More in Taxes, and I'll link to that. So let's jump into these simple tax strategies, ways that you can reduce your taxes without overcomplicating your life. I'm going to start out with the standard deduction. All right, I'm not going to spend much time on this. This is just a given. The standard deduction is just a flat dollar amount that the tax code says you can earn tax-free. You don't have to pay any taxes on this. Most recently, that was $29,200 for a married filing joint couple. And that's just $29,200 you subtract off of your income that you do not have to pay taxes on it. It's just there. There's no way in the world that you could possibly miss this, but I wanted to point it out because it does reduce your taxes. It is part of the tax code, and it is something that you get to take advantage of. The next thing is itemized deductions. Now, this goes with standard deduction because you can't do both. You can't take the standard deduction and your itemized deductions. You have to pick between the two, and you choose which one is most beneficial to you. So I just mentioned for married filing joint, the standard deduction that you get is $29,200. That was for tax year 2024. It's going up for 2025. That is there, and then you have the option to choose to itemize your deductions instead. Now, itemized deductions have nothing to do with like a rental property or a business. These are personal expenses that the tax code says you can deduct these, and the only reason why you would want to do that is if what's allowed adds up to more than the standard deduction. So the most common typical things that go into your itemized deductions are your state income taxes, your property taxes on your home. Now, those two things added together under 2024 tax law couldn't be more than $10,000. Under the new tax bill, it's $40,000. So those two things get added together, but then capped currently at $40,000. Then you can add your home mortgage interest, and you can add your charitable contributions to nonprofits. If those four things, there's other things in there. There's like medical, but fewer people are able to have enough medical to where that counts. And there's a few other things too, but these are the four main things that tend to cause people to itemize instead of taking the standard deduction. So those itemized deductions, you want to keep track of those things. If you're anywhere near or think that you're going to be over that standard deduction limit, you want to keep up with those things so that you can take the itemized deductions at tax time. Taking that, if they add up more to the standard deduction, just another way to reduce your taxable income painlessly and simply without overcomplicating your life. The next one is tax credits. Now, there's several tax credits. I'm going to go through these. The thing with tax credits is you very rarely miss these. It's something that people overlook. They don't think about the fact that they're reducing their taxes, but it's not like you're going to miss these tax credits. The first one, child tax credit. If you have kids that qualify under age 17 and your income limit isn't above $400,000, you're going to get a child tax credit. That's a dollar for dollar reduction just because you have children. The earned income tax credit, that's for lower income families, and it varies based on the size of family, but the earned income tax credit is one that reduces your taxes for low income households. The retirement savers credit, this is, again, there's a percentage of what you put into a retirement account, and there's an income phase out. But if you are putting money into retirement, there is potentially a credit to reduce your taxes. Now, if you're putting that money in pre-tax, we'll talk about this later, into like a 401k or an IRA, then that's a deduction where that income, that reduces your taxable income. But this is on top of that. This is a credit for that same money that can dollar for dollar reduce the amount of taxes that you have to pay. The American Opportunity Credit, that's for college tuition. When you're in your first 4 years of college, has to be an accredited college, and there's some limits there too. But the American Opportunity Credit is for tuition in your first 4 years of college. A lifetime learning credit, that's for college courses after you've completed 4 years of college. And you can use that as many times as you want for as many years as you want, no matter what age you are. You just have to use the money on qualified classes. So the lifetime learning credit, the dependent care credit. So this is if you have a dependent, like a child who isn't school age, you have to put them in daycare while you and your spouse, if you're married, are both working. Whoever's on that taxpayer or whoever's on that tax return, whether your head of household is a single parent or you're married filing joint as a married couple, both parents or the one parent, if it's only one, has to have earned income for that one. But dependent care credit, if you're putting kids or other dependents in care while you are working so that you can earn money. The adoption tax credit, if you adopt a child. Now there's, again, limits around this and qualifications on what qualifies for that too. But the adoption tax credit, a lot of people adopt children, and so that's a potential credit to help you reduce the cost of that. Retirement is the next one. Putting money into a retirement plan. Now, if you put money into a traditional IRA or 401k or 403b, those are pre-tax. When they go in pre-tax, they are deductions or they reduce your taxable income. That lowers your taxable income today, and that lowers your taxes. The Roth IRA, that's still a tax-advantaged account. It does not reduce your taxes today. You put that money in with after-tax money. You don't get a deduction for that. But the money grows tax-free, and then in retirement, it comes out tax-free. So it's still a tax-advantaged account. It's still a way to pay less taxes without overcomplicating your life, because if you put the money into the Roth, you'll pay the taxes today. It's just going to already be in your taxable income. It's not like you have to pay extra taxes by doing that, but it's not reducing your taxable income. However, in retirement, that's going to come out tax-free. The next one is the HSA, the Health Savings Account. And you have to have a high deductible health plan, and you have to qualify to be able to open up a health savings account based on what kind of health care plan you have. But this is by far the best tax advantaged account that exists. You can put money in, and it either goes in pre-tax or you get a deduction for it. Either way, it's reducing your taxable income today. You can invest the money that's in the HSA. The earnings, the capital gains, anything that's earned in there is tax-free. And then when you pull that money out, as long as you spend it on qualified medical expenses, now in retirement, whenever, it comes out tax-free. It's the only account like that where the money is never taxed. You put it in pre-tax or get a deduction for it, so it's not part of your taxable income. The earnings, if you invest the money within the HSA, is tax-free. And then when you pull it out in retirement, it's tax-free. Or before retirement, you can pull it out whenever you want. If you spend it on qualified medical expenses, it's tax-free then too. So 100%. The limit last year, I forget what it's going to this year, but in 2024, I believe it was $8,300. So that's $8,300 for a family plan. If you have family medical plans, half of that if it was an individual plan, that you can put in and get those advantages for. College savings, there's 529. I cannot remember, honestly, if the Coverdale accounts still exist or not. I don't have any clients that's ever used one, but 529 are very common. Some states will give you a deduction for the money you put into 529, some won't, and there's qualifications around that too. The federal taxes, there's no deduction for this. Basically, if you put money into a 529, it grows tax-free, and then you don't pay earnings on anything when you pull it out, as long as you spend it on qualified education expenses for the beneficiary of that 529 account. So no deduction right now, but tax-free growth, and then you don't ever pay taxes on that growth if you spend it on education expenses for the beneficiary. There's provisions too where if that's not used, a lot of kind of things you got to make sure you qualify for, but there's ways to potentially roll that into a Roth IRA if you don't use it for education. You can also roll it into other descendants. So if your kid doesn't use it all, you can roll it into a sibling or a grandkid's account. Then there's also brokerage accounts for minors. So like the UTMA, UMGA, UT, I forget the exact acronym for those, but basically it's a brokerage account for a minor. You can open up in your kid's name. You can put money into it. The money you put into it is a gift to them. So you want to keep that under the annual gift limit so that you don't have to file a gift tax return. Say you put $5,000 in this brokerage account, you invest it. The dividends, any capital gains, all of that's going to be in your child's name in these accounts, and it's not going to pay, you're not going to have to pay tax on that at your income level. Now, you do want to be careful of the kiddie tax, KIDDIE tax, because if they're unearned income, dividends, interest, capital gains exceeds a pretty low threshold around $2,000, you're going to need to pay tax on some of that potentially at your tax rate. So this one, it's a good way to set up savings for your kids. It can save taxes, but there also comes a point where it's not going to save you any taxes because you're going to end up having to pay tax at your tax rate anyway. Investments, capital gains, qualified dividends. Let's talk about this. So ordinary income is taxed higher than any other income. If you're earning money, whether it's through a W-2 job or self-employed, you're going to pay Social Security and Medicare taxes on those earnings. You're also going to pay income tax at ordinary income tax rates. But investments, interest income, still ordinary tax rate, but you don't have to pay Social Security and Medicare tax on that. So earning a lot of interest income is going to be taxed at a lower rate than earned income working a job or having self-employment income. The next best thing, long-term capital gains. So to have a long-term capital gain, you have to hold something. You got to own it for more than a year. And this is going to be like your stocks or any investment property or anything like that. Any kind of investment that you hold for more than a year is going to be long-term capital gains. Now, long-term capital gains are taxed at lower rates than ordinary income. If you are in the 10 or 12% income tax bracket, long-term capital gains that fit within there, zero tax. So that's tax-free income if you have long-term capital gains and you're in the 10 or 12% tax bracket and those capital gains don't push up into the next bracket. Now, if you go into, the 22, 24, 32% tax bracket, those capital gains are going to be taxed at 15%. You may have to pay another 3.8% net investment income tax if your income goes above $250,000, but even then, that's 15 plus 3.8, 18.8% tax on long-term capital gains, whereas your ordinary income, if you're paying that, is going to be 24, 32%. So long-term capital gains, they always get a lower tax rate than whatever your ordinary income tax rate is. So you want to be investing. You want to be holding these investments long-term for a year or longer. Qualified dividends that come from investments that you've held for a year or longer that are U.S.-based. There's a couple of qualifications to make sure it's a qualified dividend. But those are taxed at long-term capital gains rates too. So long-term capital gains, qualified dividends, best tax rate that you can get, lower than ordinary income. Interest income, still taxed at ordinary income rates, but it doesn't have that Social Security and Medicare tax like your earned income does. So you want to be starting to think, how can I invest my money? How can I earn investment income? How can I get long-term capital gains? Also, while that is growing, your stock, if you invest in any kind of company or an S&P 500 index fund and you put $5,000 in it and it grows to 10, 50, 100, 200,000, right? Then that is not taxed until you actually sell it. So you're getting tax-free growth and you only have to pay tax on that when you sell it. And then if it's long-term capital gains, it's a lower tax rate than your earned income. It's just a win-win all around. And you can benefit from this with small investments. I mean, you don't have to be a millionaire to do this. Just start investing. Tax loss and tax gain harvesting. Tax gain harvesting, people don't talk about too much. Talk about that in a second. Tax loss harvesting. Now, you can deduct up to $3,000 of capital losses, investment losses, against your ordinary income. That's the max. So if you sell some stock and it's a loser and you lose $10,000, only 3 of that can be applied against your ordinary income. The rest would carry over and you could use it up $3,000 a year at a time. However, if you have some capital gains, hey, I've sold some stock that was performing well. I've got $50,000 of capital gains. Maybe that's not the space you're in. Maybe you got $5,000 of capital gains. Well, you can also find some stock that is losing that you want to get out of, that you want to invest in something better, sell that and offset those capital gains. And, it's kind of a win-win because you want to get out of the stock anyway. Now, tax gain harvesting is when you're in those 10 or 12% tax brackets and you can pay 0% long-term capital gains tax on these gains. So what you want to do there is if you're in that position and you've got some investments that have gone up in value, maybe you've got about $5,000 of capital gain that you haven't recognized, you haven't sold that stock, and you can sell it because of your tax bracket and recognize 0% tax on that. Go ahead, sell it, immediately repurchase it. What you've done is you recognize $5,000 in capital gains, you step up your basis, you pay 0 tax on that, and you've just increased your basis for down the road, maybe when you're in a higher tax bracket. Tax gain harvesting is huge. So look that up if you didn't understand how I explained it, or shoot me a message and I'll help explain it to you. All right, rentals, businesses. Let's get into this. Rentals can be great, but only if you actually want to be in a rental. So remember, this is don't overcomplicate your life. If you don't want to own a rental, if you're going to be stressed about a rental, this is not the move for you. Don't do this for tax. Don't do any of these things. I mean, I was talking about child tax credit, adoption tax credit. Nobody's going to go adopt a child for the tax benefits. Nobody's going to have a kid for the child tax credit. Don't go buy rental property for the tax benefits. Buy it because it fits within your priorities, your goals, and it's an investment that you actually want to be in. It is not as passive as people think most of the time. But rentals are great. You might have to take out a mortgage. You can depreciate the property. If you do a cost segregation study, you can potentially accelerate the depreciation. You might have to do something like the short-term rental strategy or the real estate professional status strategy. Both of those come with hoops you got to jump through. So you don't want to do these things if you're not going to still enjoy your life, right? You don't want to be like, oh yeah, let's do real estate professional status, and now you hate your life because of all the things that you got to do to hit that qualification. That's a stupid tax strategy. Don't do that. But if they fit, rentals can be great. They can also be great for other people too. You don't have to accelerate depreciation for a rental to be a good investment. You could still have a good investment. You could still have some good tax shielding components with regular depreciation without having to do real estate professional status, without having to do short-term rental strategy, and still benefit from that. So rentals can be great, but only if you want to be a landlord, only if you want to have rentals. Same thing with a business. Businesses can be excellent, but they're not going to reduce your taxes. Business is actually not, opening a business is not actually a tax strategy. It's more an income. It's more a personal finance strategy. I mean, you can make more money being in business for yourself. You can make less money being in business for yourself, but the opportunity is there to make far more than what you would as a W-2 employee. And yes, there are business deductions, but you don't want to spend money in your business just for the tax deduction, because you're always going to save less in taxes than what you spent on the business expense. So if you spend $10,000 on a business expense, you might reduce your taxes by $3,000. Well, I'd rather pay the $3,000 and put the $7,000 left over in my pocket than spending the $10,000 on a business expense that I didn't need. So again, this is only on things that actually make sense that for your business. You're not going to go spend money for the tax savings. That's stupid. It never makes sense in terms of actual cash flow in your pocket. Now, some people will tell you, hey, look, if you buy a car or a property, going back to the rental, and you use debt, then you didn't actually have to come out of pocket that cash, and you can save more in taxes than the out-of-pocket cash. That's true if you have a limited perspective, a short-term perspective. So let's think about this. I'll do this real quick. If I buy a vehicle, and let's say that I'm able to write the whole thing off, and it's $50,000. All right, there's a lot of qualifications for this, but let's just pretend that that's the example. It's $50,000, and I can write the whole thing off the year that I bought it. But I don't spend $50,000. I only spend $5,000. I put a down payment of $5,000, and I borrow $45,000 as a loan. All right, and you can write the whole thing off. Let's pretend you can do that. Okay, I write off $50,000, and if I'm, let's say I'm in the 22% tax bracket, plus I'm going to save on some self-employment taxes because it's a business vehicle. Let's just say I'm going to save 30%. 30% of $50,000 is $15,000. I only came out of pocket $5,000. I saved $15,000 in taxes. So that sounds like a win, right? It is, but you're going to have to pay that loan. And the interest on the loan is a business expense. But again, if you're got $1,000 in interest, and you're saving $300 in taxes because of that, you're coming out of pocket $700 for the interest. You're also going to have to make loan payments. So the cash that you didn't pay out, you're making principal loan payments. Principal on the loan is not a deductible business expense. So now in future years, you're spending money that you're getting no tax benefit for. So if you look at the whole picture over the entire life of this car, It's not as great as it sounds. Yes, it's a good benefit for people when it matches and it fits. You're going to be able to accelerate these things, and the time value of money. All of that matters, but it's not this like magic bullet. Okay, you want to think through the actual full picture of this. Don't have that limited short-term perspective. Think about your taxes in terms of your lifetime. How do I reduce my lifetime taxes, not just right now, this moment? That's short-sighted, and short-sighted people never build wealth. They always make poor decisions that don't lead to wealth building. Rental and business deductions, I've already touched on this a little bit. Spend the money if it makes sense. Make sure you keep track of it. Take the deduction because it's a valid rental or business expense. If you're a cash basis taxpayer, which most everyone is, all small businesses, most of the people that are watching this are going to be cash basis taxpayer. If you have your own self-employment business that you're running, generally speaking, you're probably going to be cash basis. You can time things. You can accelerate expenses. Hey, I've got a big expense coming up in January or February. I can go ahead and pay that in December. And again, I'm not necessarily changing my taxes that I'm going to pay over my lifetime because I was going to spend that money next year and I just accelerated it into this year. But again, time value of money. Better to reduce my taxes this year, use that savings to invest it so that I'm getting the earnings on it. You can also delay revenue. So this is just ways that you can plan your income. You can potentially keep income out of going into a higher tax bracket if you know 1 year is going to be higher than the next. You have some control, not unlimited control, but you have some control as a cash basis taxpayer to time expenses and income to help with your management of your tax brackets. That goes along with the next one, plan ahead. You cannot show up in February and March and say it's time to do my taxes. How can I save taxes? How can I lower my taxes? It's too late at that point. You need to be planning ahead during the current year and multiple years ahead. So you need to be thinking, again, long term. You need to be thinking about the year ahead. You do not need to be showing up at tax time going, how do I lower my taxes? Everything going into that tax return, when it's March of 2026 and you're preparing your 2025 tax return, that stuff is done. What happened in 2025 is over. We're now looking back to prepare a historical document about what happened. Your opportunity is looking forward right now in 2025. What can I do in 2025 before the end of the year to make sure 2025 taxes are lower? What can I do now and start to do so that 2027, 2028, 2050, I'm thinking long term, my lifetime taxes, not just this year. I already said it. Short term thinkers don't build wealth. You've got to be thinking for the long term. Stop sacrificing the future for today. All right. Keep excellent records. This one is overlooked by so many people. You miss out on deductions because you have crappy records. You're not keeping track of stuff, especially for the business and the rental owners, the rental investors. You've got to keep good records. If you're going to itemize instead of taking the standard deduction, you need receipts for your charitable contributions. You need receipts for your medical expenses if they're going to be high enough for you to be able to deduct them. If you're in business, you need to be keeping track of what you spent on valid business expenses so that when it comes to tax time, you don't forget to deduct something. Keeping good records is actually number one on the list for best tax strategies, in my opinion, and I've seen a lot of other people talking about this too. You want to keep good records. You might have a valid deduction that gets thrown out if the IRS audits you simply because you didn't keep proper records. That's enough about that. That's the main thing. LLC. Create an LLC if you want to reduce your taxes. I'm joking. The LLC does nothing for you. The LLC, if you're a single member owner of an LLC, it is a disregarded entity for tax purposes. You've got legal things that you can ask your lawyer about that the LLC does, but for tax purposes, it's literally called a disregarded entity. Disregarded. It's as if it doesn't exist. If you are the only owner of that LLC, by default, that is its status. The LLC does nothing for you for tax purposes. Doesn't open up new business deductions, doesn't change anything, doesn't validate your business. You still have to have a valid business. I can open up an LLC right now with no business. It doesn't do anything. It doesn't prove anything. All right, made my point there. If you're a multi-owner LLC, 2 or more owners, then by default you are a partnership. That doesn't change the things that you're allowed to deduct either. It opens up some other nuances and some other planning, but it doesn't open up new business deductions or anything like that. So the LLC for tax purposes doesn't do anything. Now, it could be, and oftentimes is, the first step towards making an S corporation election. S corporations can save you taxes. They can save you significant taxes if it fits your situation. You have to have reasonable compensation. If you're not earning enough money and your reasonable compensation needs to be the vast majority of what you're earning, then it's not going to save you any taxes. All it's going to do is it's going to cost you more in payroll cost. It's going to cost you more in tax prep cost. It's going to cost you more in headache and kind of admin. So it's not worth it unless the money that you're making compared to the reasonable compensation is high enough to save you enough taxes to make the S Corp worth it. So you want to sit down and talk to someone, not someone who's going to say, just pay yourself half of what you're making, not someone who's going to tell you, yeah, once you hit 60,000 of revenue, then it makes sense. No, you want them to look at what's your reasonable comp for your job and the duties you're doing for your business. This is a custom analysis that has to be done for every single taxpayer. There is no bright line test. There is no once you hit this, it makes sense. It's your reasonable comp for the work you're doing for your business, and then comparing that to the net profit that you're making and ensuring that the gap between those two numbers is large enough to save you enough taxes to cover the extra costs, cover the minor amount of extra admin and headache, and to still put enough money in your pocket to make it all worth it. So that one might overcomplicate your life if it doesn't fit your situation. I see a lot of S Corp elections that happen way too soon for businesses that don't need them, and it overcomplicates their life. But it could be right for you, and it could make sense. So there it is. Those are the ways to pay less tax without overcomplicating your life. They're the simple tax strategies that most people overlook. I don't know if you heard anything that you didn't hear before. I think you might have heard a perspective on a lot of things that you've heard about but not talked about in this way. These are the things that everyday people use to reduce their taxes without hating their life. You don't need a holding company with 5 LLCs under it. You don't need this layered trust structure. My videos are for normal, everyday people. People making $1 million or less. People making $1 million plus, you can use these too, some of them, and you might need more complicated structure, but I'm talking to the 95 to 98% of Americans out there who can reduce their taxes with these tried and true, simple strategies and still go about enjoying your life without being driven by trying to find some special secret or loophole that doesn't exist, or maybe there is a strategy that exists, but it just doesn't apply to your situation. I'm not using anything myself outside of what these strategies are. Anyone trying to sell you something else that's kind of a normal, everyday taxpayer, again, the 90, 95, 98% of you out there probably watching this video, if anyone's trying to sell you on something else, they're probably earning a hefty commission by convincing you that it's the right move for you. Probably going to make your life more complicated than what you want it to be. You're probably not going to fully understand what they're talking about. That's part of the sales tactic is, it's going to save you taxes. Trust me, I'm the expert. It doesn't matter if you understand it. We're reducing your taxes. I wouldn't trust that. Stick to these. If you have questions about other ones, or you're like, hey, I heard about this too, I'll make a video on it. I'll tell you my thoughts on it. Maybe there's something that we can add to this list. Maybe it's something that I can give you more details on. A lot of times I talk to my clients about strategies they've heard about, and when I explain to them how it actually works, what the qualifications are for it, what the documentation they have to keep for is it, what the documentation they might need to keep for that strategy is, a lot of times they'll look at me and be like, never mind, I don't want to do that. Yeah, here's how you can do it. Here's the legitimate way to do it. Do you want to do this? And they look at me and go, never mind. It sounded better than I thought it was. That actually doesn't fit my life. I don't want to do that, even if it will save me taxes. Again, I've got another video on why smart people actually want to pay more in taxes. So check that one out. It will explain some of that, and it kind of goes along with this one as well, too. Thanks for watching.